Andrew, we've seen some strong economic numbers. I've just been through them all. What does this tell you about the recovery picture in this part of the world anyway?
Well, it just reinforces, the picture that we've been seeing since the beginning of the year. I mean, Asia's got no problem with growth at this point. Obviously, there's been a lot of concern about what the slowdown in Europe means for the region, but we start off from a point of very strong economic momentum.
Would you say that this is overheating almost?
Well, that was certainly the concern at the beginning of the year. I mean, let's not forget that the story from the beginning of the year has been tightening. It's been property measures in China. It's been measures throughout the region really to try and take some of the heat out of growth. We rebounded very, very strongly from the subprime crisis. I think much more strongly than people expected. All the data you've just gone through suggests that momentum has gathered steam, if anything. So at this point, what we've really needed actually is a little bit less growth to prevent a more extreme response from governments.
Well, of course, we saw the subprime crisis, but the latest thing has been the sovereign debt crisis. It seems to have quietened down yet, but it's not gone away, has it?
It hasn't. I mean, clearly the risks in Europe remain, but what we can see is a fiscal retrenchment is starting to take hold now in the peripheral parts of Europe. We have in Germany certainly an economy that's capable of supporting, of bailing out, if you like, the more tricky parts of the region, and the ECB still has more that it can do to support to support growth. So there certainly are risks there. We wouldn't underplay those risks at this point, but the base case is still that Europe manages to muddle through.
Well, they muddled through, but how much of this is already factored in the prices of equities in this part of the world?
I think a lot already is. I mean, we've seen already quite a deep correction. That's partly been, I think, an overreaction to early cycle tightening in China and other economies in the region, and obviously that then fed through into a deeper, broader correction as a result of concerns about global growth. So at this point, from our perspective, valuations across the region are looking good. We're finding more and more stocks now that screen well for us, that look interesting as investments over the longer term, and our advice really is to use this period of weakness to add to positions.
Andrew, I'll talk to you about some of your positions, but I want to talk to you about the Chinese market in particular and how we've seen this 20% fallback take place. Down, we've got a housing market there which is showing signs of weakness. Do you anticipate that perhaps people are going to be taking the money out of that particular part of the economy, or perhaps not investing in it, and moving back into the equity markets there?
Clearly, the Chinese government has signalled quite strongly that they don't want to see overheating in the property market, and we undoubtedly had overheating in Beijing, Shanghai, and satellite cities around those major conurbations earlier on this year. Part of that's about a pinch in supply, but it's also about a more fundamental issue, which is the strength of demand for housing in China. That isn't going to go away. What the government is really doing here is trying to prevent it getting out of control. But the underlying strength of the property market is still there, and we think will be a multi-year story. So from that perspective, certain Chinese property shares now are starting to look a little bit more interesting. They've fallen a long way. This whole retrenchment in the interest rate sensitive in the property sector of China has been going on now for 9 months plus. So they're starting to see some value appear there. But I think investors need to temper their expectations. We're not going to see a bubble, or at least the Chinese government isn't going to allow a bubble to continue to grow in the Chinese property market, and that needs to be the base case for all investors when looking at these shares. So there is value there, but
Andrew?
Yeah.
Andrew, we've got about 50 seconds. I want to just rattle through some of your top holdings, if you don't mind, if you could be brief. Let's talk about Air China, one stock you like here, returning 32%. Does it have more legs?
Certainly it does. I mean, we think that the travel story in China is incredibly strong. The region as a whole has overtaken the US now as the largest airline market globally, and that's going to continue to grow over the next few years. China's right in the middle of that.
Let me get through the next one. LG Philips, let's do two of them. LG Philips and also Samsung. Let's walk us through both of these. Same reasons?
Yeah. LG Display, it's a play on Chinese consumer. It's a play on consumer globally, as well as growth in LED and 3D TVs. Samsung's a play on that. It's also geared into general IT spend globally.
Quick word on Bank Mandiri in Indonesia.
The Indonesian financial market, incredibly underpenetrated in terms of credit cards, in terms of mortgage finance. Mandiri has the broadest, deepest branch network in that country, and we expect it to continue to grow loan growth very strongly.
Andrew, good to see you. Have a good time in Singapore. Andrew Beal there, Director of Pacific Equities at Henderson Global Investors.